game of catch-up. Small caps were underperforming by 1,400 basis points over the last 12 months. Valuations got to a level we've not seen since June 2003. So you're getting a little bit of the catch-up from that. And as you point out, we're getting a little bit more on the cyclical side of things. Higher rates going to be better for small cap because it feels like, the economy is going to be, maybe slower, but certainly not in a recession. Higher rates definitely help the banks. That's a bigger part of small cap. So I think you've got a lot of momentum building, but yet we're only unwinding really what happened over the course of the summer.
Hey, Steve, it's Josh Brown. So I think you raised an important point. Huge move in rates. Over the last 8 days, we've seen the 10-year go from 1.47 up to 1.72. And we've seen an almost equivalent move in the 20-year. Right. And as we know, the Russell is like 20% financials or something like that. So right. You've got things like the KRE up big, regional banks moving, thrift banks. But we've been faked out by this before. So if we're going to ascribe most of the rally in the Russell to rates, then what is someone to do who says we're still trending towards zero in rates? This is a head fake. Like, what would be the right answer to that question?
I don't think you want to put it all on just rates. I think the fact that we're not going into a recession, I think that's come clearer, where August it felt a little bit more like small cap, or if we were going into a recession and small caps would definitely suffer. I think the earnings growth picture for 2020 gets a little bit better. I think you're probably talking about, 10% earnings growth versus down here in 19. So I think you're going to be, you're going to get the earnings growth that maybe not spectacular, but will drive performance. And the valuation gap, again, has been so wide, whether it's small versus large, growth versus value, momentum versus everything else. I think you start to look at that and you say, okay, we play a little game of catch up. We get some earnings growth behind it. The economy starts to show signs of improvement third, fourth quarter. You're going to get the earnings growth following through. And then you've got more of the run for, small caps can continue to outperform here.
Stephen, earlier this year, we were looking a lot at the Russell 2000 as potentially a play if you were afraid of the trade war impacts. Is that still something that you'd be looking at as a possible investment thesis if you do believe that the Russell 2000 might be a place to continue to put your money going forward?
Well, I'd be careful with that just because a lot of times that, the dollar is strengthening because of global weakness. Small cap's not going to hold up in that environment. Really, small cap is a risk-on kind of trade. Usually when the dollar's weakening, that's going to be better for small cap. I do want to be more domestically focused. If I'm looking at inside a small cap, again, a little more domestically focused. So industrials that are a play more on the U.S. economy, consumer discretionary, which is more obviously, just domestically oriented. That's kind of the way we're thinking about positioning. But, in the past, the weaker dollar and, we want to be domestically focused, not always work well for small cap outperforming. You would have made that argument in 15 and 16, and that didn't work so well for the first couple months of 16.